As global markets remain on tenterhook on back of geopolitical tension between Russia and Ukraine, Europe's energy crisis and rising interest rate and inflation across the globe, Indian market continues to see volatile sessions. Therefore, today on the show, we will put spotlight on your mutual fund portfolio losses, how to assess if your portfolio is in loss and how to smartly manage your losses. To discuss all of this, we have on board Hemant Rustagi, WISEINVEST Advisor, CEO. Hemant, good evening and welcome to the show. First, let's start with understanding as to what do you mean by losses. Now, if we talk about an investment portfolio, if one has adopted the perfect route of going through a diversified strategy, proper asset allocation and diversification, what would you actually mean by losses? How would that kind of portfolio show losses, or what kind of losses?
Well, Kavita, I think this is very important issue, and I think this is the dilemma that many investors face time and again, thinking that whether they actually are suffering losses or how exactly they look at losses. See, the point is, since we're talking about mutual funds are market-linked products. So especially if you're talking about equity market tend to be volatile from time to time. It's a natural tendency there. So you will see the valuation of the portfolio going up and down. Many a time, which is what we call the paper loss. Paper loss is because you've not actually suffered a loss. You've seen your valuation going down because of the market volatility. Then, of course, there is a real loss. Real loss is when you actually book a loss, which means that suppose you invested 100,000 rupees and the current valuation is 85,000 rupees and you exit from that fund. So you actually book a loss. That's your real loss. Look at the other situation, which I said, which is a paper loss or the valuation going down because of the market condition. Now, if 1 lakh has become 85, and you rightly mentioned that there are a number of factors that are making markets volatile, and we have seen that time and again. I think even it has happened in the past, it's happening now, it will happen even in the future, that for various economic reasons, political reasons, geopolitical reasons, you will see the market volatility from time and again. So whenever the valuation of your portfolio goes down because of that or in line with what is happening in the market, so that is something that I call change in the valuation, or what we call as a paper loss. It's not a real loss. Unfortunately, many a times investors equate that with a real loss. For example, especially for those who have invested in the recent past, let's say 6 months, 1 year. Now, what happens is whenever there is a volatility in the market, the maximum impact will come on your recent investment. So if you're a new investor, all your money has been invested in the last 6 months or 1 year, you will see a portfolio going down by 5%, maybe 10%. And that's where they start thinking that they have suffered losses, which they are not. It's just the valuation has gone down. So the real losses are when actually you exit. So I think it's important to understand that this is what real loss is and what is paper loss. It's important to understand the differences between these two.
So let's talk about different investment instruments that could be a part of your portfolio. How do you compare it? Because now even if to exit any particular investment instrument because you're seeing a real loss happening since a couple of months or maybe years, and you want to really change that aspect of your portfolio, how can one go about it? What would be the strategy? What could be a comparative option available based on which you can take this decision?
Well, I think very important aspect, Kavita. I think the first thing I would say that, let me begin by saying that whenever there are these kind of situation in the portfolio where you see your valuation going down or you see the losses in the portfolio, I think it's important for investors not to panic. I think that should be the most important thing, because what happens is when you panic, you abruptly or you make ad hoc decisions, you make changes in your portfolio. For example, you will suddenly change your asset allocation, which means if the markets are going down and suddenly you think that you are suffering losses, so you exit from there and go into something which is safer, like going to debt mutual funds or going to small saving schemes, thinking that I can kind of protect my losses. So it's important not to panic, especially if you are one of those investors who have planned your investment well and who have worked on asset allocation based on your time horizon, based on what your goals are. So I think first thing I would say that it's important not to panic and do not make the mistake of trying to make your portfolio very conservative, thinking that if I make it conservative, I will invest in an instrument which is safer, I will not suffer losses. But we forget a very important aspect, that there is another risk to your investment process, which is inflation, which according to me for the long-term investment is a far bigger risk, because even there you're suffering losses. Maybe it's not visible because it's not on a piece of paper, which is the value of your money goes down from over the years. So I think it's important, first thing, not to panic. Now, when you look at changes, if you're very sure about your asset allocation, like I said, if you are invested long-term money into equity, if you invested short-term money into debt and medium-term into a hybrid portfolio, because of the market, now these bouts of volatility or the fall in the market can be prolonged at times. Okay, it's not that it's happening for the first time. It has happened in the past number of times. It will happen in the future. Despite that, equity has been able to give you very healthy returns. So the key is that remain committed to your time horizon. Do not make changes just because the markets are going through a difficult phase right now. But if you have to, if you think that there is a change in the person's situation, or you think you're nearing the completion of a time horizon for a particular goal that you set out to achieve, maybe that's the time you kind of change your allocation, try to make it more protect. And in that case, obviously, either you can look at some of the debt funds, like in the current scenario, maybe ultra short-term fund or maybe short-term fund, or even if you are sure about, let's say, your time horizon, you can look at, this is a good time to even consider fixed maturity or fixed maturity plans. So I think there are options. Look at as an alternate only if you think that there is a need for you to change your asset allocations. I think it's important to keep your focus on your goal, keep your focus on your time horizon, and then continue the process of investment.
Hemant, twice you've mentioned in your answers that real loss is when you exit an investment instrument. What do you actually mean by that? How can you explain it?
Yeah. See, like I said, suppose you invested 1 lakh rupees in a portfolio, in a fund, and the current valuation is 85,000. Now, there can be many reasons why you choose to kind of exit from this fund. So when you exit from there, you actually will get 85,000 back. That's a real loss. That you suffered a loss because your principal has gone down. So that's exactly what I said, that we need to differentiate between a paper loss where the valuation goes down and the real loss when you actually book a loss. Now, here too, let me explain that. Many a time what we have seen is that investors have invested in a fund which is genuinely not doing well. Maybe portfolio is not good, the fund manager has gone wrong in his calls. They're very hesitant in terms of making a change. And the reason for that is because they don't want to book a loss, which according to me, I don't think is the right strategy at all. Because what we forget is that in the example that I gave, that 1 lakh has become 85 in any case. I mean, that there are no two ways about it. Now, what you need to see is that if it is proven after a prolonged period that this fund is not doing well, if you don't exit, it is going to be very difficult for you to kind of recover. And if the fund recovers, it may take years and there will be an opportunity loss. So I think need to understand that whether you remain in the current fund or you go into a better performing fund, your investment will start growing only from 85,000, and a better fund can help you in actually not only recovering losses faster, but also make it grow. So the real loss is when you suffer losses, but there are times when actually booking a loss is not a bad thing, as I mentioned, in the case if the portfolio is not doing well.
What should be the timing to make any changes? I mean, see, the current scenario, the market is very volatile, it's very uncertain right now, looking at the kind of triggers we are getting from the global market. How should one, I mean, we've already explained what do you mean by loss in your portfolio, but then till how long can you see these losses, and till how long, what's that comfortable zone till the time you'll be okay with your fund or your investment instrument underperforming? Is there a time period to that? Is there a time frame to that? Beyond a point, one needs to really act on it. What would be that time frame?
Well, Kavita, I think this is a very important question. There are two aspects to it when we talk about non-performance. I think first thing we need to put performance in proper perspective. Many a time we compare equity with, especially when the markets are down, and for the new investors who are not well versed with how equity behaves, they start equating it with the fixed deposit, small saving schemes. Obviously, that's not the right way. That's what I said. It's important to put performance in perspective. Now, there are two aspects of it. If you're invested, let's say, in a small cap fund, and you're very clear that allocation to the small cap is you're comfortable in your comfortable zone, and maybe it's 5% of your portfolio, and you see that in the marketplace, the small caps are not doing well. So it's not that only your fund is not doing well. As a segment, the small cap is not doing well. So there is not then, I would say, any time frame. If you believe that you want 5% or 10% in small cap, knowing fully well in the long run, what we have seen in the past that small cap has the potential to deliver best return among all the segments. Then you continue, then you're not looking at any time frame. Of course, the issue there is that if the small caps are doing well and your fund is not doing as well as the peer. So you need to kind of compare the performance with the peer group. And if in the same marketplace, if there are other small cap funds which are able to give, let's say 10% or maybe even higher return than your fund, then that's a time for you to kind of start looking at performance in a proper manner. How long do you wait? Look, it can happen with the best of the fund manager that sometimes your strategy doesn't work for some time because the money, especially it happens in the multi-cap or a flexi-cap fund, that the money move from one set of sector to another set of sector. It doesn't mean that if certain sectors are not doing well, they are not good enough, that you should not continue with them. The important point is you need to see what is the reason for non-performance. If the portfolio quality is good, it's just that the strategy is not working for some time, you allow it to continue. But like I said, if there are similar funds which have done well, I would say maybe give 3 to 4 quarters, at least 4 quarters. And if you still feel that the fund is underperforming the peer group, maybe that's a time to exit from it.
All right. So what is the real loss and how can you assess it in your portfolio? Thank you so much, Hemant, for giving all the tips and tricks of this particular strategy.